Welcome back to the 2022 Alternative Marketplace, Africa's home for the top investment managers in the alternative asset class space. Well, we've just heard from Geltec Digital Investments, which is opening up and making the world of digital investing more accessible than ever before. Next up is Brian McMillan, Investec Structured Products. Now, Brian has been involved in the market for more than 25 years, first as a stockbroker and then sales of equity derivatives before joining the structured products team at Investec, where he listed the first structured products on the JSE. Brian, over to you.
Thanks very much. Yes, as we mentioned, we have been doing structured products for a number of years. In fact, Investec has been doing these for 20 years now. Our first structured product was listed back in 2002. And that was on one of our offshore structures. We've subsequently done over 175 public launches. Fortunately, none of those have ever had an actual loss. So we've returned capital in almost all those cases. And in fact, 91% of them have returned a profit at the end of the period. We get asked, I suppose, and having done so many of these, the three questions that we do get asked is, do you need capital protection? A lot of asset managers say to us, if you stay long enough in the market, you don't need capital protection because the market will grow. But of course, people don't invest like that. They don't invest age 20 and hold it until they're 65. A lot of people are investing in different things at different times. And of course, we have the whole universe of alternatives nowadays. And what we found is that the value of capital protection has become very valuable in this time when people are chopping and changing. One of the most important things, I think, for capital protection, it allows a person to stay invested in the market when normally they would be going, I should probably come out the market. The market looks a little expensive. Certainly at the end of last year, the market looked expensive. If you have that capital protection over some of your investments, you can stay in. And of course, in South Africa, we also have the problem of a lot of people being underinvested. And when they start approaching the age where they should be switching from equity into bonds, they actually haven't built up that nest egg enough. And we're seeing a lot of people use structured products to actually remain invested in equity products because they have that level of capital protection. So in this slide here, I have just an example of one of our products. This was in 2007 that we launched this product. Just before the market had the global financial crisis. And what you can see here is it was actually a basket of a couple of different indices put together, the FTSE, the S&P, and the MSCI World. And at one point, that index had fallen by over 50% in the middle of the crisis. The blue line that you can see there is what our product did. So even though you had a 5-year product which promised you 100% capital guarantee at the end of the period, even though the market had fallen over 50%, our product never actually printed, never traded, but the bid offer price that we had never traded below 89. Or 89% of the original. And you can see over time it actually grew back. So what that allowed people to do is actually to hold through that period even when they were concerned about the market itself. And in fact, we actually went back to the market at this time in 2010 and said, look, the market has fallen over 40%. You can actually get a 93% back for your product. Would you like to restrike it? And a lot of the people actually did that, took a small loss, a 7% loss, but re-put the money back into the market when it was 40% down. So we've certainly seen the value of capital protection there, and certainly in times like we are at the moment where the market is very high. PEs at the end of last year on the US market were an all-time high before pulling back, but it allowed people to stay in the market, that level of capital protection. Another area I wanted to talk about is outperformance. So not only are we getting capital protection in our structured products, but a lot of our structured products actually outperform the market. And this is because when you buy a structured product, you can actually get downside protection, but geared upside. Now, in these two graphs, we're showing our Guernsey products. We call them our Guernsey products, which is our offshore investors. And they've actually outperformed the market over this 20-year period by giving an average annual return of over 4.5%, whereas the market itself has given 1.7%. And how we do that is through this gearing. Our JSE listed products, which are a combination of not only Rand, but also offshore, because we now have the ability to inward list, have actually done even better. And I suppose that's because they've only been running since 2010. So the markets have been much better. But again, we've been able to outperform there. And the two major reasons why we've been able to outperform is because we have these two types of products. The first one is a digital product. And what that means is that if the index is flat or positive, you get a fixed return. And that fixed return is set up front. So if you enter into a 3.5-year product over the Euro stocks in this example, and the index ends slightly positive or even highly positive over the period, you will always get that digital return. In this particular case, the investor got a 50% return in Rand. Plus, if the index is actually up more than 50% over that 3.5-year period, the investor got the full upside beyond 50. And in many cases, we saw through the early 2010s, 11, 12, when Europe was having its banking crisis, those indices, although they initially fell, they ended up 2, 3, 4% after 3 or 4 years. And these investors were getting that 50%. And that's where you were getting that outperformance. The other structure that we have here is one that's about to expire. It's a top 40 index. And what we did is on the downside, we gave 20% protection. So if the index fell 21%, the investor would lose 1. But on the upside, if the index moved up, they were getting 1.5 times whatever the index did. And that was capped at 40%. But what you can see is if you get a 1.5 times the gearing to a 40% cap, if the index goes up more than 40%, you're getting a 60% return. And that's really how people can get gearing or outperformance to the actual market by using these structured products. The next question that we always get asked is, when is the right time to enter the market? And I suppose that is the hardest one. Certainly, as I mentioned, the markets have been high. We've got inflation coming through. We're going to have increases in interest rates. And that generally has been a time when markets have underperformed. And certainly off these high levels. And again, we have these people who want to be in the market. They need to be in equities to try and get those returns. And so we have a number of strategies for that. One of the most obvious example is an autocall. So an autocall essentially gives the investor a structured product over a 5-year period. But each year we look at that, the price of the index. If it's flat or positive, the investor gets a set fixed return. In this case, this is over the Euro Stoxx Dividend Select. If the index is flat or positive after year 1, the investor will get a 10% return in US dollars. If it's not, and the market is indeed down, it looks a further year out into year 2. In this example, we show that the market's down in year 1, 2. In year 3, it's up, and the investor will actually get a 30% return in US dollars. So what that means is that you have this structured product, which is normally set for a set period, but now we've put it into chunks. So each year it has a chance where it can actually expire and give an investor an almost cash plus type return. And that's important for people that are looking for ways to invest in the market when the market is high. You want those ability to able to lock in any profits that you get along the way. With all our structured products, we like to do this back testing. Obviously, it doesn't mean that this is going to hold in the future, but when we looked back across our auto calls, we looked back and said over a period of 14 years, which is through the global financial crisis, through a pandemic, what happened to that index if you bought one of these products on each of those days, going back to 2008? And what we found is that a lot of these products call in year 1. In fact, the Euro Stoxx Dividend Select, over 65% of the time it called in year one. In year two and year three, obviously much less so. But I think the important thing here is that in only 10% of the time was the index down for more than 5 times. And in other words, at the end of 5 years, the index had never been positive on any of those years. And what we found there is that the investor was getting their cash back. So they had capital protection at that point. The only time they didn't have capital protection is if the index was down more than 30%. And in fact, that happened in less than 2% of the cases. All of those cases, incidentally, were if you'd bought them in 2005, 6, and 7, and when they expired in 2008, the market had been down over that 5-year period. So that's really the 3 things that I want to talk about. The first is the value of that capital protection allows people to stay in the market longer than they would have. The ability to outperform on the upside, so they have alpha, they have exposure to the market, but they have geared upside. And that gearing doesn't mean they have geared downside. It just means that the upside is geared. And then these autocalls or other types of products that actually almost look like a cash plus enhanced return when markets are uncertain, which they certainly are at the moment, then investors can still invest in the market because they have those 5 different chances to actually receive a return.
Thank you, Brian. And unsurprisingly, they are quite popular at the moment. Are you seeing much institutional interest in these kinds of products?
So over the last 4 or 5 years, we've certainly seen people coming into the market who actually bought our structured products as a retail side asset managers and are now using them in this space of normal active asset managers. And I think it's really because of that, those kind of skewed returns where you can get geared upside and protection on the downside. Certainly we're seeing more of that.
And in terms of the future of the space, I mean, you listed one of the first ever structured products in the country. What do you see as the future?
So I think what we're going to see is these become more and more commoditized. At the moment, they're sold through IFAs, they're sold through wealth managers. I think over the next few years, we're going to see these arrive on platforms. You're going to be able to choose, different indices, different levels of capital protection, different levels of gearing. But I think that's further down the line. South Africa tends to be behind in that kind of thing. We catch up very quickly when there is a new idea. But I think the move to platforms is something that's going to happen in the next few years. And then also this continual shift towards offshore markets.